लाइन पे कर दी। ये तो पब्लिक की है। हाँ ये पब्लिक क्या है? ये भी तो मैंने बोली है, वहाँ से ऑडियो नहीं है। म्यूजिक चलवाता हूँ भाई। कुछ चलवा
Eminent guests, ladies and gentlemen, a very good evening to everyone. I am Pankaj Sharma, Director with CareEdge Group and your MC for the evening. On behalf of CareEdge Group, it gives me immense pleasure to welcome you all on this momentous occasion. We are honored to have you all with us today in the flagship event of CareEdge Global, That Dialogue 2025. It's a moment of pride to see this distinguished gathering, thought leaders, policymakers, regulators, global financial experts, and industry stalwarts, all united by a common vision to strengthen the world's trust in India's economic story. Our theme tonight, ratings and economic resilience, building global confidence, could not be more timely. In a world shaped by uncertainty, one force defines sustainable progress: trust. And trust, when backed by transparency and credible ratings, becomes the currency of confidence in global markets. Tonight's dialogue is not merely about numbers. It's about narratives of credibility. It's about how economic resilience and institutional strength are inspiring confidence across borders. Let's set the tone for this powerful evening as we embark on a journey exploring global trade dynamics, cross-border capital flows, and India's rise as a trusted voice in the international financial ecosystem. With that, let's begin our proceeding with the thematic presentation. Please join me in welcoming Mr. Nitesh Jain, Chief Ratings Officer, CareEdge Global IFSCA, for his presentation that sets the context for our discussions tonight, highlighting the evolving global credit landscape and the state of economies across continents. Dipesh serves as a Chief Rating Officer at CareEdge Global IFSCA Limited with nearly 2 decades of experience in leadership positions across credit ratings, research and advisory. Nitesh brings in depth knowledge of various sectors. Over to you, Nitesh.
Thank you, Pankaj. Good evening, everyone. Before I delve into today's theme, let me share a brief of CareEdge Global. CareEdge Global IFSCA Limited, or as we call CGIL, is a 100% subsidiary of Care Ratings, the flagship company of the CareEdge Group. The group has been in ratings for more than 3 decades and has rated debt of over $2.5 trillion. Interestingly, Care is the only homegrown rating agency among top 3 rating agencies. It has been holding second position for a long time, notwithstanding the presence of 3 global agencies in the country who are operating through subsidiaries here. The group has presence in other Asian and African regions such as Mauritius, South Africa and Nepal. CareEdge Global received license from IFSCA and launched operation last year. CGI is now accredited with RBI as a global rating agency. We started our operation at scale with coverage on 39 countries representing 85% of the world GDP. These countries are well spread across continent, 13 in APAC, 10 in Europe, 9 in Americas and 7 in Africa. Within first year of our operation, we are amongst top 10 global rating agencies in terms of number of countries, and we endeavor to inch up further by end of this year. Here is a distribution of our sovereign ratings. We follow globally accepted rating scale, which is AAA to D. Currently, 4 ratings are negative outlook, which are marked in red, and 1 rating is on a positive outlook, which is marked in green. Beyond sovereign ratings, we have assigned ratings on debt of more than 4 billion debt instrument across 20 issuers within our first years of operation. As you can see, our clientele is well diversified across corporate, infrastructure and financial institutions. Within the first year, we are proud of many marquee names here. This also shows our operational readiness across domain. We have built a strong team and aspire to create a truly world-class institution. To start with our methodologies, which are transparent, objective and relevant in today's world order. On left side of the slide, these are the pillars of our sovereign methodology. These pillars are by and large similar to what other global rating agencies also follow. But the difference in the weightages of these pillars, we have ascribed higher weightage to the objective parameters, which are the top 2. The combined, they score 50% of our overall weightage, and the balance 3 are the remaining 50%. While we have looked at these parameters at an overall level, what we have looked at differently is the sub-parameters. On the right hand side, you see there are differentiators of our methodology, and this is also a mix of 2 categories. One, where we find the gap in the legacy methodology, and other, we have looked at the new parameters which are relevant in today's world order. For example, if you look at the first parameter, which is economic structure and resilience, there are 3 ways to look at an economy: size of the economy, growth rate, and GDP per capita. Our methodology looks at these 3 parameters holistically, which is being often missed by the other legacy methodology. For example, India's economic size is large, our growth rate is superlative, and in fact, but our per capita income levels are low. No wonder India's rating has not moved in last 20 years. Only recently S&P has moved the rating up, while the other 2 are still at BBB-, because they still look at one of the parameters which is considering the rating rather than looking things on a holistic manner. We focus on transparency. Our methodology, our detailed rating rationales, all are available on our website freely. Like our methodology, our rating is also a differentiating factor. We created our committee with a majority of external committee members having extensive experience in a global credit or economics. For example, Paul, which is on the left-hand side of the chart, he was a global head of S&P based out of US and Singapore then. Currently, he is based out of Australia. The second person from the left, he was the CEO of S&P China and Hong Kong. Dr. Dash has extensive experience in the African market. Similarly, Dr. Banerjee is a professor based out of UK. All our rating decisions, be it sovereign or corporate, are taken in the rating committee comprising these eminent global experts. Furthermore, we have onboarded global experts as our advisors. Mark Adelson, who was working in S&P and Moody's. In fact, he is widely accredited in objectifying S&P's criteria after the global financial crisis. Pawan Agarwal, who is seated here, He was working in Kruse for 3 decades. In fact, he was the one who set up Kruse's Global Analytical Center, the division which works extensively with S&P. The team size is now more than 1,000. And he also worked with S&P in Singapore on a secondment basis. Mr. Arun Sharma, he worked as a CIO in IFSCA US. So let's look at how our ratings are faring vis-a-vis other rating agencies. If you see the table on top, that gives you a quick summary of our ratings when we started vis-a-vis other global rating agencies. For an example, vis-a-vis S&P, 18 ratings of ours were same, 8 ratings we were higher, and 12 ratings S&P was higher. Since then, we have seen rating convergence on 17 countries. Let me repeat, 17 countries we have seen the rating convergence. On the left-hand side, you see the table where we had given higher ratings and other rating agencies have moved closer to our rating. I already talked about India, where we had given a BBB plus rating. S&P has now moved to BBB from BBB minus. Similarly, we had assigned A plus to Portugal at a time when S&P was A minus. In last 1 year, S&P has moved up by 2 notches. A very rare rating action in an A category by 2 notches, as we can see here. On right hand side, you see the list of countries where we have given lower rating and other rating agencies have now moved closer to our rating. Case in example, France, where all 3 rating agencies have moved closer to our rating and they are broadly aligned to our rating. Moving on to the theme of today's event, ratings and economic resilience. Our theme today is focusing on resilience across 4 continents, given the global uncertain environment. So let me just first talk about what we are talking about from a global uncertainty. Let me first talk about the trade, which is the cause of concern or cause of vulnerability in today's time. If you see this chart, the teal color indicates the economic policy uncertainty. Black line depicts the world trade growth. As you can see, since 2006, world has witnessed quite a few disruptions, starting with GFC, followed by US-China trade war, COVID-19 pandemic. But at the same time, the policy uncertainty, which is the teal color, was never as high as it is today. This makes the global trade in an uncharted territory. So this was the first point where we were talking that the vulnerability. The second point of the trade, which is coming from a globalization to globalization. What we mean in this chart, let's look at. So here, this data is depicting the export as a percentage of the world GDP. In the first section, which is shaded in green, that talks about the super growth period. As this was the era of rising interconnectedness among the global economies. A period can also be labeled as a hyper growth, hyper globalization. In fact, the share of export to GDP jumped 1.5 times to 28% in this time. However, post GFC, this level has stagnated. You can say that we have labeled this as a globalization. So what's happening is we are seeing countries are becoming more and more inward-looking, or perhaps we are seeing a flattening of the global export in the old context. Let's look at the other lens, which is the FDI. Here we see FDI from 1980s. This chart talks about the FDI in net trade flows in 1980s. As you can see, the trajectory has reversed since GFC. This can also mean that economies do not have the surplus which used to be there in the earlier time, which, or the other way could be that they are looking inward. This is an interesting chart. In fact, if you see, USD has depreciated 8% in the beginning of this year. What we have looked at this parameter more from a structural point of view. The left chart shows that the share of USD in the total currency reserves has come down to 66% to 58%, while it shows a moderate decline, but this also shows a trend. The interesting chart is on the right hand side, you see the gold. In fact, the share of gold in the central reserve currencies has gone up to 18% from 8%. No wonder why the gold prices are rising. So let's look at that overall trend. In fact, while this is the economics presentation, but the rating analysts can't get away with without saying debt even in the economics presentation. So this chart talks about the aggregate triple G debt, the general government debt, as well as the global debt. If you see the teal color, which shows a sharp jump in the government debt numbers post the pandemic. This was led by fiscal stimulus, subsidies, as well as the social spending done by the government. After that, we see some bit of moderation because the countries took course correction measures. However, if we see going forward, in fact, if you look at on the right hand side, this number is inching towards the pre-pandemic level of more than 100%. In fact, this is the new normal from a debt perspective. In fact, this number needs to be seen from the slower growth which we see, which is depicted in the dark blue color. So what's the impact of the higher debt on the debt affordability? This is a little complex slide, but let me just explain this to you in two parts. One, on the left hand side, you see there are arrows which are moving from left to right, which shows that how advanced economies debt burden has gone up. You see there are two vertical lines, 1% and 3%. Essentially, the advanced economies earlier paying 1% and that debt burden has moved to almost 3%. This is very substantial. In fact, on the right hand side, you see emerging economies. That debt burden or the interest cost was always on a higher side. So all in all, what we are saying is the higher debt as well as the interest cost is impacting both advanced economies as well as the emerging economies as we go forward. So what we are looking at, not the vulnerability, what we are looking at the pockets of resilience. So in this section, in fact, we have some 4 subsections where we will be talking about each region, how each region is performing and where do we see the pockets of resilience. Let me start Americas, and the first country to talk about the US. In fact, the US has been the source of vulnerability of this time. The trade conflict this time has been, it's originating from the US, but not just that. In fact, if you look at this chart here, on the left hand side, you see how the debt is going up in the US. On the right hand side, you see that how the interest burden is also going up from the US. That both the charts are depicting that how the fiscal pressure is mounting, mounting on US. And this is the time when we see the policy uncertainty is also very high in US. In fact, as we speak, we are still looking at what will happen in the US, whether they will open up tomorrow or not. So that is the kind of uncertainty which we are looking from a US. Let's look at how the things are shaping up on the macroeconomic front. Here we are looking at the inflation. While inflation, as you can see on the left hand side, is moderating from higher end to the lower end. At the same time, it's not maybe fully comfortable to pass on the benefit of the policy rates. On the right hand side, you see therefore the policy rates are still on a higher side. These developments have begun to undermine the policy credibility as well as the institutional ability, which has been the strength for the US for a long time. Having looked at the vulnerability, and as I said, our focus is not to look at the vulnerability but look at the buffers. So here are the buffers. So the chart on left shows the growth trajectory for the next 5 years as compared to the past. As you can see, most of these economies are green, indicating future growth to be better than what we have seen in the past. As depicted on the chart on the right hand side, only Canada and Mexico is having a very high level of exports with US. Other economies are not too much dependent on America, on US. But does that mean that these economies are fully insulated? The answer is no, because US and these economies have high indirect interlinkages. For example, financial market, investment flows, high degree of dollarization for several economies. Such linkages will have a cascading impact of the US monetary policy or the economies as we go forward. In addition to the stable growth, what we are seeing for most of the countries in the last slide, there are other buffers which have been mentioned in this slide. On the left, you see there are buffers in terms of the external foreign exchange, notably Brazil and Peru. Similarly, on the right hand side, you see the aggregate debt level, which is expected to remain stable even if we factor in all this impact from the tariff. Let's look at how we see the Europe. Europe, in fact, have been settled for a lower growth for a fairly long period of time. In fact, the Europe is going through the structural issues, as I said, but our focus, as I said, was to look at the pockets of resilience. So what we have done is we have classified the Europe into 2 parts. Core economies, which are the larger economies, and the peripheral economies, which are the smaller but relatively going on a higher pace. This slide on the, if you look at this chart, the chart clearly shows that the European economies are growing much lower than the world average. On the right hand side, you also see how the debt level is expected to go up as we go forward. But situation is different when we look at the peripheral economies. Peripheral economies are expected to outperform the regional average, helping offset some of the regional drag. This differentiation is attributable to the reform orientation as well as resilient investments. Importantly, debt levels are also projected to decline. As you see on the right hand side, there are more greens than red. The green indicate the improvement in the debt trajectory as we go going forward. One important factor in this region is the ECB, or overall we can say the EU institutions which have been acting as a stabilizing agent. On the policy front, the ECB continues to play a pivotal role in terms of the monetary policy, in terms of euro as a currency. At the same time, they are also providing the funding support. These things help the region to navigate these tough times. Moreover, on the right hand side, you see most of these economies have a surplus current account balance, which also supports the region in the tough time. Going on to Africa, where you see that we have positive outlook on Nigeria as well as a negative outlook on Botswana. So how do we see the region at an overall level? If you see this chart, again we are showing the trajectory of growth vis-a-vis the past. Most of the countries you can see are in the green, which means that they are expected to perform better vis-a-vis what they have done in the past. The region is benefiting or expected to benefit from the demographic dividend as well as the ongoing structural reforms what we have seen. And in some countries you also see the benefit of diversification which will accrue as we go forward. Second point is to look at how the debt levels have performed or how they are expected to perform going forward. Again, you see traditionally the African countries have a low debt. This is not because of the choice, but this is because of the compulsion as well. Because their borrowing capacity is also constrained because of the low revenue as well as the high interest rate. But as we see, wherever they stand, we are expected that this will improve, and most of the countries still are on a green, which sees they are expected to improve as we go forward. The last point here is, as I said, there are three things which we are looking at: GDP. The G is the growth part, and D is the debt, and the third is the policy. So on the policy part, if you look at inflation, the inflationary pressure has moderated gradually, reflecting the easing of food and the energy prices, as well as the tight monetary policy. But what we see is the exchange rate volatility remains high for the region. On the right hand side, you see some countries have exhibited significantly high level of currency volatility, which despite the politics what we have seen for the overall region, the benefit will only accrue how the country is specifically looking at these reforms as we go forward. Last but not the least, APAC, which obviously is our home region as we look at. In this slide, what we are looking at is how the trade openness has behaved over the years, and what is the context only for APAC, because trade openness has impacted all the regions. But here the catch is, in the past, if you look at when we were talking about the trade openness, APAC, since if you look at the countries here, most of the countries on the left hand side are from the APAC. In fact, 4 out of 8 countries are from the APAC, which indicate that APAC has been high on the trade openness. In fact, because of this region, in the past, APAC has benefited the most. But in the current situation, things are, APAC is on the receiving end. So this is broadly the context which we will see how these the trade impact is impacting all the countries. And here you see that we have trifurcated all the countries into 3 categories, you can say. On the leftmost, you see countries which have a better growth prospects, which include India as well as Philippines. On the rightmost, where we see the impact maximum for the countries like Vietnam, South Korea, as well as Singapore. So since we have looked at the growth, let's look at how we see situation or how we see the sovereign debt levels for the APAC countries. This chart compares how the debt level today vis-a-vis 2030. And basis, again, we have classified these countries into 2 parts. India again comes out as a clear winner in this case, which is again in a green. This is particularly important to assess what is the fiscal headroom if we look at the trade-related challenges for the region. Let's look at how the region has accumulated or built the resilience over a period of time. This is a very good example where despite we are talking about the trade and the open economy in the APAC, we see how the APAC economies have strengthened over a period of time. On the left side, you see, most of the economies still have the current account balances which are in surplus. Even some countries have a deficit which is still on a marginal level. So all in all, we see the countries have built strong buffers in terms of the current account balances. On the right hand side, we see how they have built buffer in terms of the foreign exchange reserves. Moving on to the policy part or from a rates point of view, on the left chart again you see dark blue lines, they are representing the movement of the inflation from the peak to the present level. As can be seen that inflation has eased for most of the APAC countries, and therefore we see APAC countries are better placed in terms of the absorbing any shock which can come from the external part. Let's look at how India is placed in all this in this overall context. So on the left you see what's the impact of tariff. We all know India is subject to 50% tariff. While this is not our base case, in our base case we expect India to range somewhere 15 to 25%. We'll see how things are going to shape up. But let's say if the 50% is to remain, certainly it will have the impact. On the right hand side you see how things are going to shape up from some of the key sectors. It could be electrical, it could be textile, RMG, gems and jewelry. These could be impacted if the tariff continues to persist. But let's see how structurally India has changed over the last 20 years, which was a key factor for us to look at BBB plus vis-a-vis the other rating agencies. So here on the left hand side you see India's service export, which is much more resilient. In fact, you see the number has almost doubled in the last 5 to 6 years. We are almost hitting almost $400 billion. On the right hand side you see how India's forex position is standing vis-a-vis the other global counterparts. In fact, you see India standing tall even on this parameter. Not just that, in fact, on the financial or the fiscal level as well, India's debt position is expected to moderate as we go forward. In fact, it's very contrary to what we have seen at a global level, where we were expecting the debt to actually go up. In fact, this is broadly which we look at from an India perspective. But let's look at how each of the region is looking like at an overall summary. For America and Europe, you can see the color which is slightly on the reddish side, which shows the vulnerability. In Africa and Asia, you see the green color, which shows how we see this situation going forward. To sum up, American economies, excluding US, are largely stable. Peripheral European economies are faring better. Africa as a region is a region of potential. Reform plays a key role for country-specific credit outlook. APAC is a region of stability as a resilience. This was our perspective. We will further deliberate these points in the panel discussion with our eminent guest. With this, I'll hand it over back to Pankaj. Thank you.
Thank you, Ritesh, for that insightful and data-rich presentation. An excellent foundation for the dialogue that follows. We now move on to one of the most awaited segments of this evening, our panel discussion on ratings and economic resilience, building global confidence. This conversation brings perspectives from across the world, policymakers, economists, development finance experts, and rating specialists to decode the forces that are shaping global economic confidence today. The discussion will explore 4 interconnected themes that define the world's financial landscape: tariff and trade dynamics, economic resilience, building global confidence, and structural shifts and ratings. To moderate this discussion, please welcome a leader known for an analytical depth and global perspective. Ms. Revati Kasture, CEO CareEdge Global, IFSCA, and Executive Director, CareEdge Ratings. Ms. Kasture brings over 25 years of experience in ratings and research and has played a key role in CareEdge's growth in the past decade. Welcome, Revati. Joining her are our distinguished panelists. May I call upon Mr. Aurelien Kruse, Lead Country Economist, World Bank Group. Mr. Kruse is currently the lead economist of the economic policy team in India. Before this, Aurelien worked as an economist in Ghana, Kazakhstan, Nepal, and Kenya. His work spanned decentralization and intergovernmental fiscal relations, debt management and debt restructuring, and growth and poverty reduction strategies. A very warm welcome to you, Mr. Kruse. May I now invite upon Ms. Kamalika Das, Regional Economist, South Asia, International Finance Corporation. Ms. Das is the Regional Economist for South Asia for the International Finance Corporation. She has almost 2 decades of experience in tracking macroeconomic and market development. It's a pleasure to have you with us, Ms. Das. May I now invite upon Mr. Sachin Gupta, Chief Ratings Officer and Executive Director, CareEdge Ratings. Mr. Gupta brings over 22 years of leadership experience across the rating industry and has taken over as CRO of CareEdge Ratings in 2021. Welcome, Sachin. And joining us online is Dr. Dipesh Shah, Executive Director Development, International Financial Services Centers Authority, IFSCA. Dr. Dipesh Shah is the Executive Director and he heads the Development and International Relations at IFSCA. He has over 23 years of professional experience in international business, project development, corporate affairs, corporate law, and policy matters. Welcome, Dr. Shah. Ladies and gentlemen, please join me in welcoming our distinguished panel with a big round of applause. Over to you, Revati, now to begin the panel discussion.
Thank you so much, Pankaj. And good evening to all of you, ladies and gentlemen. Thank you so much for coming down to be with us today evening. Nitish made a presentation detailing, the uncertainty index which has gone over the roof. It was going off the charts. There is trade conflicts which are going all across the world. You're finding dollar in a different space today. You have, impact of all of this on different economies, and this is, I guess, never before a time when all this is happening at once. So, in that context, I would like to, pick the minds of these, seasoned professionals. And understand what is their perspective. So the first questions to Aurelien, to you, is that what opportunities and risks do you see because of the shifting trade dynamics, and what are the opportunities and what are the risks that they present themselves with for emerging and developing nations? Because you've worked with emerging and developing nations throughout your career graph.
Yeah, so thanks a lot. It's a tough act to follow the previous presentation because the speaker covers so much ground in so little time. I'll try to live up to that standard. Risks and opportunities in the current disruptions. The one thing that I think the charts that we saw earlier show pretty well is that despite the fact that we have all these shocks, global trade has not declined, right? Global trade maybe isn't growing as fast as it was before, but it has stabilized at very high levels. So this idea that, from one day to the next, we entered into a completely different world, I think is a little bit overblown, right? So I think there's still tremendous opportunities because the pie is really big. It may not be growing, but it's still really big. And if you think about the magnitude of the piece that China still represents, if India, if other countries, emerging market economies, were to capture even a slice of this pie, that would still be a very, very significant boost. So I would err on the side of optimism and saying, the world hasn't collapsed yet, right? And there are in fact a lot of opportunities that are out there. And so the risk is the flip side of this. The risk is that we overreact, right? I think there were a lot of good reasons why, after the experience of COVID and given the uncertainty, de-risking has become, an important dimension of policy making. But, let's not throw the baby with the bathwater. De-risking is one thing. closing off is another thing, and that I see as the big risk. And the big risk is that those who want to close off feel empowered, feel emboldened, and take this as a license to go way overboard and to give up what's been good about the global integration that we've witnessed over the past couple of years, and it's still very much alive.
Great, so there's a quite bit of optimism over there. Do you share that optimism, Kamalika? Especially because you look at Southeast Asia or South Asia, and the trade openness of these economies has been significant, as we saw in the earlier presentation too. So, are you optimistic about them in the current trade scenario? And if yes, what makes you?
Thank you. Yes, we saw quite a lot of very interesting charts in the previous presentation, and I'll break it up. So Southeast Asia, per se, it's probably too early to talk about trade impact, like I just mentioned, that we haven't seen a real fall in trade yet. To US, sure, but the rest of the world has kind of made it up. So for Southeast Asia, with the exception of maybe Vietnam, which is pretty badly hurt, three things. So the domestic share of the value add of the exports to the US is probably fairly low for most of these countries, except Vietnam. The relative differential between the tariffs imposed on the specific sectors are similar. So it's not really so much of a relative competitiveness loss, more as a reduced demand from US, which is really working here. And thirdly, over time, they'll be able to re-diversify their export base. And for Southeast Asia, China is a very important factor. It's not just the US, so China's throwing a bit too. So that will have spillover incremental impact. But so far, first half growth has been has held up. So we'll see, but yes, they have a lot of buffers to fall back on. South Asia, of course, I won't go into the details. We know what's going on with India. The rest are not so badly affected, but then Bangladesh, Sri Lanka, of course, specific sectors, textiles, etc., will be affected. But going forward, if we believe that they can diversify markets, there are opportunities. There are opportunities to undertake structural reforms, which will set it on a higher growth path. The regions should fare well.
So you're seeing resilience as a theme, as a central theme through the region.
As of now, yes.
Yes. Okay. Great. Dr. Shah, my next question is to you. And I would like to understand, GIFT is a very new and emerging concept, a new IFC from India. So how, this is a very opportune time, I feel, for GIFT to kind of grow and flourish. So can you tell us what are the opportunities that GIFT offers as compared to the other IFCs in the region, and what are the unique advantages that you would like to state here?
Sure. Thank you, Devji. I hope I am audible, and my apologies that I'm not there physically. But nevertheless, I never seen myself so big on the screen, so I feel that it's good that I'm on VC right now, not physically there. But thank you for the very important question about how the India is going in terms of development of its own international financial center. I think there are two parts to what India is trying to achieve. One is that in terms of what India is trying to build, in terms of the growth that it is seeing for last so many years and for next 20-25 years, I'm sure my fellow panelists would agree that the way India is projected to grow for next 20-25 years, there will be a lot of opportunities for financing the growth. And for those opportunities, you always were relying on the smaller financial centers outside, whether you would rely on Mauritius, Dubai, Singapore, and other financial centers. So what was more eminent for India was to create its own financial center, which helps two things. One, create more business within the Indian ecosystem rather than exporting those business outside, and create more jobs in India. I think from both this perspective, the IFFC fits into a very important role play which India is trying to achieve for financing and creating its own financial services center. Now, if you really see from a hinterland demand, I'm saying hinterland because the IFFC in GIFT City has been declared as an offshore center. So while you are in India, this zone has been declared as a non-resident zone and thereby making it at par with other financial centers outside. So no foreign exchange law domestic applies apart from the law that the IFFC has, and giving you all the flexibility to operate the international financial services business on the same principle as you would have operated yourself from Singapore, Mauritius or Dubai for India opportunity. And combining these two aspects, I think what is most important is providing it a regulatory enabler through a separate unified regulator and a tax regime which is in line or probably competitive with other financial centers. With these two combined, what are the numbers which are coming out from GIFT City? And I'm sure many times, unless and until these numbers are spoken, we always believe that GIFT is still an emerging in terms of the financial sector. But we are just about to publish our quarterly bulletin which comes out with all the numbers, and I am happy to inform this gathering that we already crossed $100 billion in banking asset size as we speak today. And these are numbers which are spread across 30-35 foreign and Indian banks put together. Funding India, 75% of our funding has gone from GIFT into India, and 25% of the funding has gone offshore from GIFT, which is again a testimony that it works on both the principle, on the inbound and outbound both sides. But I think from your larger question that you asked me that, what is that the financial sector is trying to achieve? I would put it that with the growth of the Indian economy projected for India at 2047, I think GIFT would probably be put as a financial center which can help a lot of inbound financial capital to come with a very comparable regime that financial institutions get from outside. At a very competitive cost, one can operate from this financial center. And also to add to that, you are also able to create large number of jobs in the Indian ecosystem. So all this put together, I would say that probably the Government of India's policy initiative has been very timely to make this financial center on the principles of an offshore center within India.
Great, thank you so much, Dr. Shah. Taking that same thread of trade and uncertainty ahead, as a rating agency, and you look at India with a magnifying glass, you're also on the rating committee of CareEdge Global IFSCA Limited. So how do you, as a rating agency, incorporate this trade and uncertainty in your rating assessments?
Yeah, thanks, Revati. So, the way we look at it is the first order impact and second order impact. First order impact is obviously the entities which are exporting in a big way, their revenues, their profits, those get impacted, so we kind of factor that in. Thankfully for India, our exports to US as an overall economy is only 2% of GDP, so it's not a systemic risk. Sectors like textile, shrimp, diamonds, they have been affected and they are not very capital intensive sectors. So we are not seeing much of stress at a systemic or a financial system level. So that is another thing. First order impact. Another impact is also on the supply chain, because some of the reactions of this high trade tensions has been supply chain. We've all have read about the rare earth metals not being exported, which has an impact on the supply chain of say batteries or automotive and chips and other allied businesses. So that is the other impact that we see, whether the supply chain of our domestic companies, whether they are secure or not, because people will use whatever tricks up their sleeve when there is so much of pressure. So this is more direct. What we are seeing as a second order impact, and which is where we are seeing Indian companies are getting impacted, not so much, but still that's a potential, is when the overall protectionism in the world goes up, say China is kind of levied such high tariffs by US and they're not able to export to US, then what happens? They obviously start dumping the materials into other markets, including India, and at a very marginal cost for production. And that has been kind of upsetting, say sectors like petrochemicals in India. The prices, the yields have been very, very badly affected. So I believe that while from an Indian perspective, when we look at the credit ratings, the direct order impact is not as much. But the second order impact is where we have to be careful, both on the supply chain side and on the dumping. While the Indian government has been kind of supportive and reducing or rather levying both tariff and non-tariff barriers to protect. But then that gets us to the third order impact, that if Indian government starts protecting these industries, then the fear is that they will not be competitive enough. And what Aurelien said, that we will again become very protectionist, which is then we will not be able to compete globally, which is, I think, the order of the day. We have to be more competitive, but by being protectionist, we may not be able to invent and innovate and focus on that. So these are the various things that we look at. Yeah.
Great. So you're also kind of saying, and as of now it's resilient, but the second order impact is something that worries you. Yeah. Okay. So moving on to debt, and only this question is for you. We see governmental debts across governments increasing, and how do you at the World Bank Group look at this governmental debt increase in terms of balance with the fiscal position that they have and the debt sustainability for future years?
So thanks. It's a very broad question, right? So I don't know if you want me to talk more about India or about the world in general, but I can talk about developing economies.
Sure.
I could talk about France, which is my country, but I'd rather not, given what I've seen about the CareEdge ratings of my country. Look, developing countries have gone through a really, really tough time. They've had two massive shocks. They've had the COVID shock, in which they had to dig really deep into their pockets to keep the lights on, make sure people could get on with their lives. Then immediately afterwards, price of food and fuel shot up, and very significantly so in these countries. So again, the need to continue supporting the economy was big. And then you had the increase in interest rates globally, which made their debt service extremely expensive. And that's how you ended up with, like half of countries, for example, on the African continent being either in debt distress or at risk of debt distress. So really setting back the kind of development agenda quite a bit back. So how do you deal with this, right? How do you manage that tension between the fact that on one hand you have like headwinds to growth, which in theory would support more spending, and these very kind of limited or limiting constraints on debt, which call for consolidation and rationalization. So one big topic is domestic revenue mobilization, right? I mean, this is something that at least at the bank we talk a lot more about, and it's true for India, by the way, right? I mean, the potential to raise more domestic revenues is very significant in a lot of these economies. The trick is, if you want to do this well, you have to do it in a way that is progressive, and you have to do it in a way that is smart in the sense that it doesn't, deter economic activity. And the problem is that, governments and elites are typically not prone to wanting to do that, right? So it really depends on the social consensus and also the ability of the government to offer a quid pro quo, because if you tax more, you have to deliver better services, right? And that's the social contract. But domestic revenue mobilization is clearly something that one could look at, including in India, by the way. But the other thing is spending better, right? Subsidies. There's a lot of talk about freebies in India, and that's something that people like to talk about. But subsidies. The IMF estimates that the volume of subsidies in the world each year is about $2 trillion, right? unless you think that these subsidies are very well targeted and really go to the core of, to the constituencies they're supposed to meet, and that they're very well, managed, there's a lot of room there to spend more wisely and to redirect expenditures to where they're most needed. I'm not going to comment on India per se, but you can very well imagine that this is an issue that is important. Then the other thing is, debt is not bad per se. Debt is bad if it doesn't generate productive assets, right? So public investment management is the money spent well. We've done a lot of work, for example, in India, looking at different states and the way that states spend their money and the types of outcomes that they get for public spending. There's a very big variation, and it's not always where you would expect it, right? And it's not always the better performers in terms of growth that spend the best, and there's a lot of learning across states that can be achieved. Okay, debt management clearly is key. It's more true, I guess, for African countries that maybe went non-concessional when they shouldn't have. And one picture that we need to see is debt. And I was wondering about the slides that the colleague showed for Africa. Debt is external debt, but it's also domestic debt. In many African countries, as external debt became much more expensive, they started maxing out on domestic debt, and that creates all sorts of problems in terms of crowding out the private sector, in terms of exposing the banking sector itself to the kind of sovereign bank nexus. I'll just say one last thing. Debt is deficits, interest rates, and growth, right? That's sustainability. And growth at the end of the day is really what gets India to be perfectly comfortable living with a 7% budget deficit, and France to struggle with a 5%, or 4% budget deficits. And for those who are interested, so I'll make a shameless promotional plug. The bank just released this country economic update about India, looking really at the structural, constraints to growth and opportunities to go from, good to great, and to reach the Viksit Bharat goal. So I'll emphasize really there's a lot you can do on expenditure, there's a lot you can do on revenues, but at the end of the day, growth is a big part of this story.
Absolutely. So, you're talking about countries should look at increasing their revenue so that debt becomes sustainable at the end. That's where, the whole thing is. How would you answer this question with respect to the APAC or the Southeast Asia economies? How do you kind of look at debt sustainability from their aspect, given that their trade openness was extremely high, and therefore the growth impact will also be high?
Yes, so to begin with, compared to maybe South Asia, their debt levels are lower, but their trade impact will be much higher, and the fiscal situation is similar. There isn't a lot of leeway to provide a lot of stimulus. I mean, China has provided some of it, but it's not at the scale that they've done before to really support growth. So what we've seen other Southeast Asian countries, what they're doing now is, say for example, Vietnam or Philippines or even Indonesia have instituted a lot of reforms, and some of them are on the fiscal front and exactly dealing with what Aurelien just mentioned on revenue mobilization to make it better, the bureaucratic capabilities, public investment management, which is critical. You might have a surplus or you might get the revenue right, but then spending it properly also becomes a problem. In South Asia, we've seen some of this. Some of them are IMF program driven, so Sri Lanka is trying to make these kinds of reforms in its budget spending, revenue changes, some progress on investment, public investment management. So it will take time, but it's effort well spent, because fiscal headroom is very, very constrained for everyone, regardless of where their public debt levels are.
Very true, very true. So Sachin, from an India perspective, how do you see, the debt levels for corporate India and the resilience of corporate India with respect to this situation that we are in?
So I think for corporate India or overall India, if we see, I would break it at macro level and then the corporate level. and the financial system. I think 3 levels if we see. So at an overall macro level, we seem to be in a fairly sweet spot. The inflation is low, the interest rates are low, coming down further. The gross fiscal deficit is also, at least government has a clear focus on reducing it further, while it had increased because of the capex and infrastructure investment, etc. So overall, at a macro level, we are quite safe. One of the best positions we have been in many years. At the corporate level, if I see, there is a 6-monthly study that we do as a rating agency, and there we come out with a study of credit ratio, which is the number of rated entities which have been upgraded to downgraded. And that ratio has been quite consistently high. In the recent 6-month period, that ratio was 2.56, which means for every 1 downgrade, we upgraded 2.5 companies. And this is similar across other rating agencies as well. So essentially, the credit strength of the corporate India seems to be very strong, especially in infrastructure and BFSI. And coming to the BFSI, which is basically banks and financial institutions, that again gives quite I would say, a vote of confidence. If you see the NPA levels, the non-performing assets of the Indian banking system, again, that is one of its lowest levels. Yes, there was an equity infusion by the government. They did a lot of cleaning up 5 years back. But now, if you see, the incremental slippages are not really high. The whole, structural reforms of IPC, NCLT, etc., seems to have played its part, and the corporate defaults are low, and therefore the NPAs are very low, and also the banks are reasonably well capitalized. So overall, from a debt perspective, I think if you see at the government level, you see at the corporate level, and you see at the financial institution level, at all the 3 levels we are fairly confident. The only level where there are some murmurs, is the indebtedness of the retail, which is basically individual. Now that is something, as an economy, as a society, India has been relatively less leveraged, so we are still lower than many of the developed economies, but yes, that is where the leverage is increasing, and we will have to see. Till now it is not a matter of concern, but that is something that we are watching out closely. Thank you.
Thank you, Sachin. Dr. Shah, the next question is for you. And we have a house full of corporate honchos in this audience today. So what is the message of what innovative products, what transactions that they can look forward to doing through GIFT?
Sure. What we have seen in last 3 to 5 years is large number of India's borrowing through the ECB, external commercial borrowing, has moved into GIFT City. In fact, as we speak, 40% of India's ECB is now going from GIFT City into India, and this was before the financial sector came into play. This number was 0. So you have incrementally now brought in the external commercial borrowing, which was all coming from outside through GIFT City into India. And I think for corporates, this is something that they've been structuring through GIFT City in terms of borrowing, also for their expansion plans and also for their acquisitions. They are taking the funding from GIFT City. We've also seen a lot of Indian corporates using GIFT City for their acquisitions outside of India, and those funding has also been navigated through GIFT City structures, which is also very encouraging. In fact, as we speak, we just concluded a transaction where first time a foreign bank, a Standard Chartered Bank, and the Indian bank, Bank of India, they both joined hands to do an aircraft financing deal through GIFT City. Now, which was obviously unheard of in terms of what India was trying to finance through its various projects, but this has also become a reality. We are now seeing a lot of aircraft which are going to be coming into India, almost 1,500 aircraft ordered by the Indian Airlines over the next 10 years. Large number of that funding is, as we speak, the GIFT City leasing ecosystem has grown more than 300 aircraft financing from GIFT into India. And we have also seen such financing happening for locations like Vietnam and others from GIFT City. From Indian corporate perspective, also insurance and reinsurance is emerging as a very important area here. We have seen a lot of reinsurance deal for the India is happening from GIFT City now, as in the order of preference, the GIFT City gives you an added advantage of using your own financial centers versus outside. We have also seen corporates using the trade finance platform here, which is the bill discounting platforms that the GIFT offers. So a lot of trade finance products have emerged from GIFT City for India, and probably that is the one area that the corporates in the room should look at when they are trying to undertake their trade finance deals. We have also seen now the wave of listing, that the Indian corporates can come and the unlisted companies can list into the GIFT City stock exchanges. In fact, as we speak, the regulations have been cleared for the foreign companies to come and list on the GIFT City exchanges, and also the Indian companies to come and list on the GIFT City exchanges. So that's another area which the institutions can look at. Also, I would add that the corporates can look at creating the investment vehicles or the holding company structures in GIFT City. I think we have seen many of them using, say, Netherlands or using locations outside for creating holding company structures, and the GIFT also similarly offers them the same structure now to create those holding company vehicles within the GIFT City ecosystem. And probably last but not the least, what we've seen is a large funding ecosystem emerged in GIFT. We have 305 funds as I speak are registered in GIFT, 194 managers, and almost $70+ billion of commitments that these funds are going to raise. And they've already raised $24 billion of commitment. They invested close to $12 billion in India and around $8 billion outside India from GIFT. So a lot of capital going into the infrastructure financing, is also going into venture capital and several other categories of funds which are launched here. So all this put together, I think for Indian corporate, probably it makes a lot of sense to keep their first call of option to see what one can offer from GIFT, and if they are not getting it at a competitive cost, obviously they can look at the global markets to finance their needs.
Okay, thank you so much for listing out the opportunities for Indian corporates at GIFT. My next question is to you, Kamalika, and this is largely to do with attracting foreign investments. You see FDI flows are actually slowing down all across the globe. So can we look at innovative financial structures for long-term financing, PPP models? What is IFSCA doing in that direction across the various countries that you look at?
So you're right about foreign flow slowing down, and it's also linked to trade. So global trade slows down, it will have an impact on foreign investment as well. But in the emerging and developing space that we work in, we also do employ some amount of concessional capital for countries which are eligible to use it. But unfortunately, that pool is rapidly drying up. There's very little available at the moment. So what we have to concentrate on is how to use very little of it, but still catalyze more investment. As far as innovative instruments are concerned, globally we have done structures like risk participation, risk sharing, which are like mitigating risk of sectors which are perceived to be higher risk and where the financial sector would not take an exposure in. So DFIs can step in and share that risk in some proportion so that appetite is built.
Like a partial guarantee.
It could be guarantees, could be enhancements, could be just sharing so like a risk transfer for a financial institution for a certain section of portfolio which could be deemed riskier than the others. Could be a variety of these kinds of instruments. On the other hand, say for infrastructure, and you have to do like a public-private, sometimes the project structuring and just making it more bankable, transaction advisory, these kinds of things also work in making it more palatable for private investment to come in, and you don't necessarily then require a lot of concessional capital. So what we operate on is like minimum concessionality, and there's also this thing is it's not about the price. You can't lower interest rates on it. It's basically trying to catalyze a market which would not otherwise get financing. But once it develops, then the private markets can take care of the credit demand there.
So essentially developing the space so that private investment then kicks up. Is that what you're saying?
Yes, it's more catalytic in nature, and sometimes mitigation sharing, could be advisory, in very small countries could be in the form of grants. It's a combination of a lot of tools, especially now, we know we have a huge SDG annual financing gap, and we will require lots of tools to bridge those gaps every year. So, and also the other thing that we're trying to do is move away from like lend and hold kind of model to more like recycling capital. So whatever assets we use, we would try to maybe securitize it out, so it's off our balance sheets and creates more room for us to lend more to emerging markets.
That's pretty interesting. So I think that kind of churns your capital better and makes avenue for private sector to participate.
Precisely.
Yeah, perfect. So we saw the slides on dollar losing its sheen, and in the past 5 years, I think the fall of dollar in the currency basket of central banks has been more pronounced than it was ever in the last 20 years. So, Aurelien, to you, what do you think are the economic, geopolitical reasons of this entire de-dollarization which is happening?
So I'll actually have a slightly different twist on the story. I think the slides actually showed more continuity, right, than anything else. So it's not like, things have changed dramatically. And what I think is interesting is not like the dollar is being replaced by any single currency. It's just its dominance is gradually declining at the benefit, or at the benefit of many others. And what was really interesting actually is I was expecting to see crypto, I was expecting to see the renminbi, but these were clubbed into others, right? I mean, it's still yen, euro, pound. So it's not like suddenly we're in a completely different world order where, like, say, the renminbi is becoming the next global currency. In fact, I was shocked by how little renminbi reserves you have given China's, predominance in global trade. So my perspective would be a little bit different. It's not a story about the dollar being replaced, it's just the dollar losing gradually, very slowly, its kind of exorbitant, privilege or prominence in the total landscape. I personally don't have strong feelings. I think it's, it's logical that that companies, that countries would want to hedge. Right? I mean, obviously, if you diversify your basket, you're less exposed, but there's trade-offs, right? I mean, the ability to have a global liquidity anchor that acts as a shock absorber, that has the depth, the liquidity of the U.S. market is a benefit that should not be underestimated. The beauty about the dollar is it's counter-cyclical, right? I mean, the dollar tends to strengthen when the world is in crisis. So you have this kind of natural hedge against shocks with the dollars, and having more currencies in your basket just complicates your kind of management, right? So as a sovereign or as a company, you have to factor this in. But I'd be curious actually to turn the question back to you guys. As a rating agency, how do you rate non-dollar reserves in your assessments of sovereign credit? How do you rate gold reserves? I mean, are they as liquid as we think? Are they as powerful reserves as we think? I'd be really curious to know actually what you guys think.
No, I think I agree with Aurelien that it is that directionally we are seeing dollar kind of reducing its sheen. Otherwise, it's still more than 50%, as I saw. I think 55 or 58%. From our credit perspective, we don't honestly differentiate as much in one currency over the other, because still 58% is this thing, and some part of percent change. I don't know if that was before the gold becoming, really jumping up, and maybe that has some percentage effect. But in general, we look at an absolute level of the foreign currency reserves as a key factor, for external stability, all that. But we are not yet. But yes, if there are, going forward, if it is renminbi or crypto, then I think it will be a good point to kind of dwell over, as a rating agency. Yeah.
Kamalika, the same question to you. What do you think are the implications of, the reduction of the sheen of, or what to say, de-dollarization? I don't think Aurelien agrees with that to a large extent. But what are the implications of this on the sovereigns? Do you think that any credit implications on, because there are reserves in dollars, and dollars is depreciating against other currencies, which means those reserves are also in a way depreciating.
That's a tough one. But then I'd like to break it up into a short term and a long term. The de-dollarization, I would tend to agree. I don't think we're there yet. And the basic requirements that you require, like of an actual reserve currency, I don't think we have a really viable contender there yet. Of course, on the margin, the share is reducing, of course. But then trade linkages, you need viable capital markets, deep, liquid enough capital markets, you have to allow movement to and fro, etc. That I think, and the sharp depreciation we've seen in the dollar index, 9 or 10% already, is more domestic developments and everything that's going on. So I'm not sure that's structural, really. It's more cyclical. So hence, we don't know if this will sustain. Also, like the rate cycle linked, etc. So I'm inclined to think this process will take longer. So hence, by then we'll have established a sort of an equilibrium. I don't think it's I wouldn't link the current dollar depreciation cycle to the overall structural trend. It usually happens. I mean, we've had other reserve currencies which have given way to others. But then it's a long-term process, and I would personally de-link the two for the time being.
Dr. Shah, my next question is to you. So what are the regulatory steps that IFSCA is taking to harmonize standards and reduce friction for global financial institutions and for kind of comparable experience at IFSCA?
I think for us what was important is that being a new regulator on the block, we did not have a backlog of using the old laws to get started. We could probably study the other comparable models outside, and because we are more outward oriented rather than inbound, we could take examples of the successful regulations across the globe, and that has been our benchmark in terms of the approach towards developing the regulations in the IFSCA zone. And we have seen almost 35 business segments emerging from GIFT City. While we were talking of a traditional financial center, housing, capital market, banking, insurance, GIFT has moved much beyond in terms of as a financial center. It houses today players from various segments, including finance companies and fintech firms and foreign universities and so on and so forth. You really find a different class of institutions all operating within the ecosystem and obviously all riding on the regulations which are benchmarked with the global best practices. So that's what our policy parameter has been, that if some businesses which is and most of the businesses in GIFT are globally oriented, then the regulation should also look at from that perspective, and that has really helped us in terms of our approach till date. But at the same time, there are challenges, in terms of when the new products are emerging and the new challenges emerging globally. One has to be a little careful, as we are, in terms of our development, we are just 5 years old as a regulator of the zone. And obviously, there are quite an established financial centers with the regulators which are also grappling with the issues which keep emerging from financial sector. So I think it's a balanced approach which is helping the IFSCA to be on ground and also look at the global best practices.
Okay, I'll ask my last question to Sachin before we open the floor for any questions. Sachin, we talked about currency, and what do you think are the key opportunities or risks for Indian corporates to raise money overseas?
Yeah. So I think a few things that have happened over the last, I would say, almost a decade is that now India is seen as a very stable investment grade currency. So that allows them, the Indian corporates, to borrow. Earlier it was mostly an FDI or a portfolio FDI and FPI kind of investments, but now we are seeing more serious, long-dated money of foreign currencies coming, and that's where even our rating agency is kind of playing an active role there. So I think the challenge will be more on the FDI side. We've already seen net FDI actually degrowing, and especially with the fight, and we see Donald Trump kind of signing deals with Korea and Japan and EU for $500 billion, $600 billion. Whenever such news come, I really wonder that is it our investments which are going in those countries? And plus, obviously, there is a challenge for Indian corporates to invest their own money, because in this whole protectionist turf, it would be ideal that if we can access foreign currency. So overall, I feel that on the debt side, we will get more money. On the FDI side, I'm a little skeptical, and we are already seeing the this thing. But yes, on the debt side, with stable investment grade rating, more and more Indian corporates will, in fact, even the regulator, they are opening up ECB norms, even RBI is kind of easing up things. So generally my belief is that we are looking at more and more debt. We also got included in the global debt index, etc. So I think the foreign currency debt is where I will be a lot more optimistic for funding the India's growth story.
So we have about time for some few questions, and I open the floor for questions. If anybody wants to raise, please raise your hand and we'll get the mic. Looks like we covered a lot. No questions today. There's a question.
Hello, my name is Aman. I'm part of Invest India. My question is, if India wants to develop their FDI inflow, and we take two examples, which is US, which is the consumer of the world with high consumption rate and low savings rate, and the other end is China, which is the producer of the world, which has high savings rate, and the consumption it's not so much. With those two spectrums, where does India should venture into with the aim to develop their FDI, and how can they do that?
So I can take a crack at the question. I think it's for a long time I was arguing that something was really wrong with India's FDI, right? Because 3% of GDP or 2% of GDP or even lower is really way too small for a country growing at 7%. And on top of it, with so many advantages going forward, stable macro in a huge domestic market and a great geopolitical kind of alignment. So just didn't make any sense, right, for India's FDI to be so low. But then if you start looking and unpacking a little bit, first you see that it's a global phenomenon, right? I mean, it's really a global phenomenon, and your guess is as good as mine, I think, on why it's declining so dramatically. But it's good to see things in that perspective. And then the other thing is the decline in FDI is a decline in net FDI, right? So it's not that there's less incoming FDI, but there's a lot more repatriation. And that to me is really the question, right? Why aren't those profits generated in India reinvested in India? I think something that maybe we don't talk enough enough about is bilateral investment treaties and their role. A lot of those treaties have expired, are being renegotiated, and there's some changes in terms of the jurisdiction that applies to litigation, arbitration, etc. So that could be something to look at. But at the end of the day, there's no silver bullet, right? It's about doing business, the investment climate. Even in a world where global FDI is going down, I think India has so much going for it that it really should be in a bigger league. So that tells me that there are specific issues with the investment climate that is deterring foreign investors from either coming in or staying in the market. And so it's incumbent upon all of us to understand what these are and for policymakers to address them. I don't want to speculate too much on what they could be, but the basic elements of predictability, implementation effectiveness, regulatory certainty, due process and appeals, all of these things are really important for foreign investors. So I think they would be important here. The bottom line is that yes, it's a global phenomenon, but given all its advantages, given its growth rate, given the presence of a huge domestic market, India is really punching below its weight when it comes to FDI for sure.
Thank you for that. Any other question?
Maybe I can add one thing. India is not really India. There's so many states, right? And some states are doing really great. So what really puzzles me is why can't Tamil Nadu be replicated in other Indian states, right? I mean, there are clear success stories about ecosystems in which companies feel actually confident to put in their resources. So what can we learn from that experience? How can other states emulate those that have been performing better? I think that's a really interesting question that gets a bit de-emphasized when we talk about India, when in fact there's a lot of different constituencies there that are sharply different.
Okay, great. Thank you so much for that perspective. And I think that's what we have time for today. The minister is on the way and he will be on the dais soon. Over to Pankaj.
No, thank you so much to our esteemed panelists and our moderator for the truly thought-provoking and multidimensional discussion. The conversation beautifully captured the essence of our theme, and this dialogue has reaffirmed two powerful truths. First, resilience is not about avoiding shocks, it's about absorbing them and emerging stronger. Second, in an era of global flux, confidence is not inherited. It is earned through credibility, consistency, and clarity of vision. May I now request Ms. Revati Kasture to kindly felicitate our esteemed panelists. Mr. Aurelien Kruse. Kindly give a big round of applause, guys. Ms. Kamalika Das. And many thanks to Dr. Dipesh Shah for joining us online. Thank you, Dipesh. And thank you so much, Sachin.
Thank you so much.
For your perspective. Thank you, guys. We're expecting the minister to be here at any moment. Ladies and gentlemen, the Honorable Minister is here and he can enter any moment. May I request you all to kindly rise and give a big round of applause. It is our proud privilege to welcome our Chief Guest for the evening, Honorable Minister of Commerce and Industry, Government of India, Shri Piyush Goyal ji. Joining him on the stage are Mr. V. Chandrasekharan, Chairman, CareEdge Ratings, Mr. Rajiv Bansal, Member of the Board, CareEdge Ratings, Mr. Mehul Pandya, Managing Director and Group CEO, CareEdge Ratings. Shri Piyush Goyal ji is the Union Minister of Commerce and Industry and Member of Parliament, North Mumbai Lok Sabha. He has previously served as the Leader of the House in Rajya Sabha and held the Ministry of Consumer Affairs and Food and Public Distribution, Textiles, Railways, Finance, Corporate Affairs, Coal, Power, New and Renewable Energy, and Mines. It is indeed an honor for us to have among us a leader whose vision, conviction, and commitment have been pivotal in positioning India as one of the most trusted voices in global trade and investment. Under his stewardship, India has demonstrated that reforms and resilience can go hand in hand, earning confidence from markets, investors, and nations alike. May I now request Mr. V. Chandrasekharan, Chairman, CareEdge Ratings, to kindly welcome our chief guest with a bouquet, the Honorable Minister. Thank you, Mr. Chandrasekharan, and thank you, sir. Ladies and gentlemen, let's take a brief moment to reflect the journey of CareEdge Global. May we please play the CareEdge Global journey video.
In the heart of India's emerging global financial hub, a new chapter in credibility and trust is being written. CareEdge Global Ratings, empowering global capital markets. With a mission to offer credible, transparent, and globally benchmarked credit ratings and analytics, we are a definitive source for reliable and trusted insights, enabling superior decision-making. As the first global credit rating agency from India to offer sovereign and global scale ratings, we bring local expertise with a global perspective. Strategically located at GIFT IFSC, we operate under a robust regulatory regime, fostering transparency, speed, and innovation for global financial participants. CareEdge Global Ratings, your gateway to informed decisions. Strong parentage and domain expertise, in-depth understanding of emerging market, alternative perspective on global ratings with transparent and robust methodologies, better accessibility and responsive local presence, full-scale rating services that are relatively affordable. As India emerges as the world's fourth largest economy, CareEdge Global Ratings is ready to facilitate the flow of capital to global economies through our reliable ratings. CareEdge Global Ratings, powering confidence in capital, credibility in ratings, and clarity in decisions for the world from India.
CareEdge leads, others follow.
Partner with us. Visit www.careedgeglobal.com to know more.
Story of purpose, progress, and partnership. And this is just the beginning. Now may I invite Mr. Chandrasekharan, Chairman CareEdge Ratings, for his opening remarks. Mr. Chandrasekharan is a qualified chartered accountant and retired executive director investment at IFSCA of India. He has more than 3 decades of experience in life insurance finance, housing finance, and mutual fund investment, with adequate exposure to a gamut of investments. Over to you, sir.
Good evening, friends. Honorable Shri Piyush Goyal ji, distinguished guests, esteemed colleagues and friends. It is with immense pride and privilege that I welcome you all to the dialogue, CareEdge Global's flagship program for thought leadership and strategic exchange. Today, theme resonates deeply with our mission to empower capital markets through credible insights and robust analytics. We are truly honored to have with us Shri Piyush Goyal ji, whose visionary leadership continues to shape India's economic trajectory from pioneering logistics reforms and industrial competitiveness to championing deep tech innovation and grassroots entrepreneurship. Shri Goyal ji, on behalf of the entire CareEdge family, I extend a heartfelt welcome to you and express our deepest gratitude for gracing this occasion. We look forward to your insights that will undoubtedly enrich today's dialogue and guide us towards a more confident and connected global future. Thank you.
Thank you, Mr. Chandrasekharan, for the opening remarks. Now, may I request Mr. Mehul Pandya, Managing Director and Group CEO, CareEdge Group, to share his thoughts on the theme for the event. Associated with CareEdge since the year 2000, Mr. Pandya has been instrumental in shaping the organization's growth journey, successfully incubating and nurturing its business in India and overseas. He'll speak on how economies can become resilient in today's uncertain global environment. Over to you, Mehul.
Honorable Minister of Commerce and Industry, Shri Piyush Goyal ji, Chairman CareEdge, Shri Chandrasekharan, Independent Director of CareEdge and former Civil Aviation Secretary, Shri Bansal, His Excellencies, the ambassadors from Uruguay, Peru, Argentina, Iceland, First Secretary of Republic of Belarus, and Second Secretary of Republic of Eritrea, World Bank lead economist, and economists from IFSCA, and distinguished dignitaries. Good evening to all of you. It is a great honor and privilege to welcome the Honorable Minister, sir, amongst us today. Sir, in one of the speeches, you had mentioned, and I quote, India's youth is very aspirational. That aspiration is driving him to work harder, adopt new technologies, new languages, and new countries. This is helping the youth to embrace an entrepreneurial culture that will make Bharat a global powerhouse of innovation, new technology, and new ideas. In response, I humbly state that CareEdge Global Ratings is a live example of this spirit of new ideas and innovation. As the chief guest at our 30th anniversary event 2 years back, you had envisioned CareEdge to become the first homegrown credit rating agency from India to enter the sovereign and global scale rating space. We are proud that we could turn your prophecy into reality. Not only has CareEdge Global Ratings risen to the 6th rank globally in terms of number of countries rated, but we have also seen convergence of ratings assigned to 17 countries by major global credit rating agencies towards our ratings in the very first year of our operations. In all humility, we believe that this is no mean achievement and provides us significant conviction on the robustness of our risk assessment model and methodology. We are also encouraged by increasingly positive response from governments across the globe covering the emerging and the developed economies about our transparent criteria and approach when they interact with our rating team. So, we are in the era of competitive economics, and in this, economic resilience is the key. We believe that it could be requiring focus on 3 key areas. First, there is no alternative but to implement key structural reforms, something that is always challenging politically and socially. However, we carry full conviction that if anyone can do it, it is this government under the visionary leadership of our Honorable Prime Minister. Second, nations need to build supply chain resilience through diversification. And third, redesigning of the financial market institutions and the architecture related to trade, payments, and reserves that shall add to the resilience. Clearly, building and enhancing resilience in the current context, especially the volatile times that we are witnessing, has become the priority of all major economies globally. This also sets the context for us to understand from you, sir, as to how the government plans to undertake this journey towards a more resilient economy, supply chains, market access, and robust financial architecture. I am sure we shall find it fascinating. Thank you, and Jai Hind, sir.
Thank you, Mehul, for that powerful address. And now, the moment we all have been waiting for. Once again, it's a singular honor to welcome our chief guest, Shri Piyush Goyal ji, a reformer with conviction, a policymaker with purpose, and a statesman who believes in empowering enterprise. So, we are privileged to have you with us. The stage is all yours.
Chairman Mr. Chandrasekhar, Director Mr. Rajiv Bansal, with whom I worked many years while he was in government and always smiling and willing to do new things. My good friend and somebody I believe very committed to making a difference to our institutions, to developing CareEdge as truly a world-class international institution, and who has put in a lot of labor passionately to develop CareEdge into a global organization, Mr. Mehul Pandya. Distinguished Excellencies, who have joined us on this very important board to discuss about ratings and economic resilience, and the two really go hand in hand. You rate economic resilience. All the distinguished participants of this program, ladies and gentlemen, I don't know if you've already paid condolences to the... No. May I request everybody to stand for 2 minutes to pay our condolences to those who lost their lives yesterday. Om Shanti. Thank you. It was a very dastardly attack, and an attempt, I think, to try and hit at the very root of our economic resilience, our economic growth story. More so because a lot of people cannot accept the way India is going forward, the way India is sitting on the high table today, working its way in the Amrit Kal to become a developed economy, a prosperous economy, Viksit Bharat 2047, the collective commitment and vision of 1.4 billion people. But I can assure you that, as the Honorable Prime Minister said, all responsible for this dastardly act will be brought to justice. No one will be spared. I must place on record the very good work that CareEdge has been doing. It's, in some sense, it's a testament to their unwavering commitment to India's growth story. It also demonstrates their confidence in the economic potential of India. And I think it's a journey that has just begun. I think they have a long way to go, lots to achieve, lots of work to do. It's going to be a laborious task, particularly when you're pitted against three giants who have international backing, who have large global operations behind them. I think this effort to go global with the local flavor is very deeply appreciated, Mehul Bhai, and my best wishes to you, your entire team, and the commitment, the excitement, the enthusiasm that I see every time I meet him and his colleagues is truly infectious, and I have no doubt in my mind that this is going to be a success story. My best wishes in all the good work you're doing. In fact, you've kept this dialogue on a very important day. Today also happens to be the National Education Day. It's the birth anniversary of Maulana Azad, who was our first education minister, and who in fact initially made huge efforts to try and unshackle the education system from the colonial mindset that we had, that we inherited from the British. It has been many years since independence, but it was only with Prime Minister Narendra Modi coming in and at the clarion call that he gave on 15th August 2022 when we celebrated 75 years of independence, that we as a nation realized the importance of shedding the colonial mindset, which somehow it seeped into the Indian ethos, into our thinking. The years of subjugation, first the Mughal rule, then the British rule, had left behind a weak mind that was not willing to confront the world with confidence, pick up big challenges, and somehow we were still working in the shadow of systems that just prevailed over the years. Prime Minister Modi has been making a systematic effort to promote India, to promote Swadeshi, to promote all that is Indian, bringing pride and culture to each citizen of India, changing our thought process to start respecting Indian capabilities, and that makes CareEdge and the work that they're doing without an international backer, without somebody from a developed nation dictating what is going to happen in India, what is going to be done in India. And I think this is a remarkable testimony to the resilience of CareEdge ratings also. In fact, for long we have wondered why India's rating was not being upgraded despite such tremendous achievements. Look at the macroeconomic fundamentals of India today, probably amongst the best in the world. We have high growth, we are the fastest growing large economy, low inflation. What was it, 1.55% last when we read? This year at an aggregate average would be probably under 4%. Strong foreign currency reserves of $700 billion, amongst the top 5 in the world. A very robust banking system. Never before have we seen a stronger banking system than today. In fact, the mood of the nation itself reflects a confidence that India or the world had never seen in India. You take any parameter that rating agencies usually would look at. External debt, we don't have too much external debt. Certainly no patch to some of the very developed and advanced countries who would have a AAA rating, sitting on piles of huge external debt. Our fiscal deficits are very much in control. On revenue deficit, we are very, very modest. In fact, if you look at the amounts that we are spending on infrastructure and juxtapose that to our fiscal deficits, we are actually borrowing to create infrastructure for the future. But rating agencies with their lord and masters sitting elsewhere could not see all of this, could not recognize this story for years on end. It is only after CareEdge created a very robust framework on which they assessed the India growth story, the India achievements. It is only when they came out with a paper explaining why India was being wrongly classified and should receive a better rating, that I think others realized that no more could they avoid or could they close their mind or eyes to the reality of the India story. And I compliment CareEdge and your team for this wonderful work you have done. Keep it up. Keep that confidence. And this is only a part of getting rid of that colonial mindset that Prime Minister Modi articulated on 15th August 2022 when we celebrated 75 years of independence. In fact, they say an economy is strong, but an economy will only remain strong if it commands confidence of the rest of the world. But before you command confidence of the rest of the world, you have to have that confidence in you. each one of us has to believe in ourselves, in our story. Then the world will follow, then the world will recognize our true potential. In fact, for that matter, despite all the data and all the experience and years of history, I don't think any of the established or let's say globally recognized rating agency foresaw the 2008 global financial crisis. They kept giving AAA rating to all those companies. Post facto, becoming wise is very easy. And therefore, to my mind, CareEdge ratings now going global, understanding the India context, understanding our potential, our resilience, will be able to resonate very well with the rest of the world's situation, other developing countries, less developed countries, other comparable economies will be able to benefit from CareEdge ratings, very deep connect and understanding and learnings from what they are doing in India. What you mentioned just now is very heartening, Mehul Bhai, that 19 countries have been re-rated, getting closely aligned with the rating that CareEdge Global gave them. I think it's truly a phenomenal testimony to your ability to track the situation on the ground. And in fact, we have so many distinguished ambassadors and heads of mission here, senior officials from different countries. I think it's high time we all started looking at our own story from the lens that CareEdge ratings has provided to us. Because it may suit some other countries' agencies to keep all of us in a particular bracket, despite all our achievements. But I don't think at least a nation like India is going to accept this anymore. We stand up for ourselves, we stand up for what is right. Credit rating agencies have an important role in the virtuous cycle of growth, because ultimately the investors look at the ratings that the agency gives. Basis that you raise investments, you also raise business confidence. That business confidence will lead both to capital flows and debt flows. Banks look up to ratings as an important criteria. Credit is extended. Entrepreneurs or businesses take bigger and bolder bets with the confidence that they have received from the ratings. Jobs are created, taxes are earned and paid, profits are earned and taxes are paid. Whenever there is signs of a difficulty, caution is also brought to the forefront. Of course, dramatic distress signals sometimes may occur and may require very dramatic response. But I find that very often even small disturbances or changes are exaggerated by some of the agencies, and possibly very good entities who may not deserve to literally go down the tube suffer because they panic without understanding the India situation and story, and actually the distress signals that they give are disproportionate to what the reality is. And that's where I would urge CareEdge also to play a responsible role to help investors, bankers, the stock market, everybody to really be able to sift deep distress from minor inconsistencies or problems. Ups and downs of life, ups and downs of business will always be there. But I think there's a big difference between a collapse and a disturbance or a slight anomaly. And good, robust agencies can always sift the wheat from the chaff, can always make a proper assessment. And as your ratings help people to perform better in their job, I think they become more and more valid and more accepted. I have urged whoever uses ratings under my watch to give prominence to ratings done by our own Swadeshi rating agency. I trust and believe you will do a good job. Keep your righteousness and your conscientiousness always at the forefront of the work that you do, because the entire business of credit ratings is about credibility. And I do hope more and more people will start using CareEdge and to help it develop, help it grow, help it build up better databases, better technologies, fine-tune their models so that they can truly become a global world-class rating agency. And instead of other agencies only following them, the world should be following CareEdge ratings and should be demanding CareEdge. In fact, some of you may recall Prime Minister Modi had also said that we must reduce our dependence on foreign weapons for our defense, foreign energy sources, foreign dependence on foreign critical technologies. In that same light, I think the Indian banking system, the Indian credit rating system, and all these are very well regulated, very strongly administered, run by our own people who also possibly run global Fortune 500 corporations very admirably. So Indians have the ability and the talent. We only need to make sure it's channelized properly. And I would urge you to continue on this path. It will be laborious. We still have a lot of people who go by the old thinking. But I think in this day and age of change, we'll also see change happening very fast. I would urge you to approach all the developing countries, all the less developed countries, help create robust credit rating systems for them also, recognizing and respecting the local situation of each of these countries, earn the trust of these countries, as well as earn the trust of bankers and investors through more accurate analysis and assessment of the situation there, creating better and better frameworks. Towards that end, I think a greater focus on developing indices or quantifying the data that you can collect about an entity in a framework that is very robust, that is dynamic, and captures the essence of the business they are in, will be very, very helpful. For example, the other day, some exporters from the MSME sector, engineering exporters, told me that they are rated by benchmarking them to their peer group. And a small 100, 200 crore engineering company or company which processes steel products is benchmarked to a JSW Steel, which is a $100 million company, just because they are both in the steel sector. I think it's quite ridiculous. Whoever has come up with this framework is answerable. How can an MSME of 100 or 200 crore rupee turnover be benchmarked to a company with what, 50,000 or 100,000 crore rupee turnover? I don't know who's responsible for this, but maybe CareEdge should take it up in your various engagements with the regulators. You have to benchmark peer to peer. You have to benchmark, create a story that really reflects the capabilities of a company based on its size. I'm told, for that matter, that there is no company in the MSME sector which has a AAA rating. Zero. Zilch. And I've refused to accept this situation. Our MSMEs are fantastic. They make us proud by the good work they're doing. Many of them are doing. And I would love to see somebody prepare a more accurate framework to respect and recognize and give credit to those companies for the good work that they are doing, so that bankers also recognize that and start giving them the right rating and the right interest structure. Investors start recognizing their capabilities and show interest in investing in them. Stock markets, when they approach the stock markets for listing, get the right rating for the size and scale of operations of that company. I'm not asking you to benchmark a steel company with a chemical company, but certainly you cannot benchmark on size with chalk and cheese. Similarly, I think some more visibility in the global market would help CareEdge Global become more recognized and acceptable. So it will mean investments, it will mean hiring some of the best talent available, both local and supplementing with Indian talent, having some regional offices in different parts of the world, maybe something in Latin America, something in some 2 or 3 places in Africa. Probably even go to the United States and set up an office. Go to Europe and set up 3 offices. Pick up all the countries where I'm doing an FTA. You'll get a span across the world. And set bold targets. Don't compromise to be second best. We are in 25. We should have a 5-year vision, 10-year program. And we should be seeing more and more people flocking towards CareEdge to get the best for their portfolio, for their investments. I think some bold target that 50% of the emerging markets or emerging developing economies accepting CareEdge ratings in their economy would be a great story for India. It would truly make you a multinational. So lots of possibilities, lots of good work to be done by all of you. I'm a big fan of Mehul and his whole team for the perseverance with which they have worked over the last 3-4 years. We've been having this dialogue between him and me and his team and me almost for 3 years now. on similar lines. I have not deviated, so there's consistency and resilience in our thinking. And I hope we'll continue to see that same consistency in performance, resilience in operations, confidence in performance, confidence in your work, confidence in your people, and earning the trust of the marketplace over the next few years as we move towards Viksit Bharat 2047. Let's aim for our own robust, credible, world-class rating institution from India. My best wishes to you and your team. Continue this good work, and any help that you require, I'm always a phone call away. Thank you very much.
Thank you so much, sir, for that insightful and visionary keynote address. Your words reaffirm our belief that India's economic future will be defined by its credibility, not just its capability. May I now request Mr. Rajiv Bansal, Member of the Board, CareEdge Ratings, to kindly felicitate the Honorable Minister, Shri Piyush Goyal ji. I'm overwhelmed, sir. Thank you so much again. As we move ahead, let's remember, ratings build credibility, credibility builds confidence, and confidence builds nations. As we draw this remarkable evening to a close, may I invite my colleague, Mr. Akash Jain, Head Corporate Affairs and Strategic Business Partnerships at CareEdge Group, to deliver the vote of thanks. Over to you, Akash.
Good evening, sir, and everyone. I'm running full of emotions today after hearing you. So if I fumble, sir, please don't mistake me. So Honorable Shri Piyush Goyal ji, respected dignitaries, esteemed panelists, distinguished guests, good evening. It is a privilege to deliver the vote of thanks at the conclusion of CareEdge Global's The Dialogue, a platform designed to catalyze meaningful conversations around global finance, policy, and sustainable development. At the outset, I extend our deepest gratitude to Honorable Shri Piyush Goyal ji for joining us today. Your presence and your words, sir, have added immense value to this platform, and your continued commitment to India's economic transformation is truly inspiring. I would also like to thank our eminent panelists. Your insights have illuminated key facets of global finance, financial architecture, regulatory innovation, and the evolving role of institutions in shaping inclusive growth. This initiative, The Dialogue, is deeply aligned with the Honorable Prime Minister's vision of Atmanirbhar Bharat, where India not only builds for itself, but contributes meaningfully to the global financial ecosystem. In that spirit, we proudly position CareEdge Global Ratings as a symbol from India to the world. To all our guests from policy, industry, and institution, thank you for being part of this exchange. Your participation reinforces the importance of collaborative thinking in addressing the global challenge. Thank you once again, and wishing you a pleasant evening ahead. Thank you so much. I would request my team from CareEdge to join us at the stage for a quick photo with Honorable Minister. Thank you.